Welcome to our analysis. Today we're cutting through the geopolitical noise of the US-Iran conflict to understand its true macroeconomic reality. Our goal is to separate immediate headlines from systemic risk for sophisticated investors. The Strait of Hormuz is a critical global energy choke point, handling a significant portion of worldwide oil and LNG trade. Recent threats of blockades have already driven rapid repricing in energy markets, signaling immediate supply disruption concerns. Current market reactions are significantly outpacing traditional predictive models for blockade scenarios. We're observing aggressive pricing of a prolonged conflict, indicating a belief in more than just brief supply disruptions by market participants. Initial market optimism for a swift de-escalation has clearly dissipated. Expectations are now consolidating around higher oil prices for an extended period, reflecting a sustained geopolitical risk premium in asset valuations. Historically, blockade-driven oil spikes, excluding extreme anomalies, have rarely exceeded a 20% increase. Once acute risk subsides, fundamentals typically reassert themselves, leading to substantial price corrections of 30 to 40%. A persistent blockade disproportionately impacts Asian economies, which receive over 80% of the volume flowing through the strait. The direct physical supply constraints will be felt most acutely in these regions, not in the U.S. The U.S. has achieved significant energy independence, largely due to the shale revolution. Our direct reliance on imports via the Strait of Hormuz is minimal, making physical supply disruptions there less impactful to our domestic economy. Even during severe historical oil shocks, the U.S. equity market has shown remarkable resilience. While immediate downturns occurred, markets typically bottomed and recovered relatively quickly, demonstrating that geopolitical risk rarely dictates long-term valuations. We're observing a strong correlation between escalating geopolitical risk and surges in traditional safe haven assets like gold, alongside defense sector equities. This indicates deep macroeconomic anxiety and institutional hedging strategies. The true systemic risk isn't just immediate disruption, but the duration of elevated oil prices. This extended period has a far greater influence on market positioning and the repricing of policy expectations. A prolonged period of high oil prices creates a domino effect. It fuels inflation, forcing the Federal Reserve into a hawkish stance, potentially narrowing interest rate cuts. This, in turn, triggers a significant valuation reset across equity markets. For the U.S., this conflict is an inflation catalyst, not primarily an oil supply crisis. The ultimate systemic risk to highly valued growth stocks lies in the Federal Reserve being compelled to abandon its anticipated rate cut path due to persistent inflation.
Thanks for watching. That's all for today's update. Don't forget to like, subscribe, and hit the notification bell for more in-depth market analysis. See you next time.